Forex, crypto, and stock courses content. Congratulations to you. You already have finished the chapter 1, which was about the money. And today we are on the chapter 2. And our today lesson is about the Forex. Let's start our today lesson. Chapter 2, Foreign Exchange or Forex. This chapter has 19 courses and also 5 parts. Let's start from the part 1. In this part, the first lesson is what is Forex and Forex history. Let's start. What is the Forex? What is Forex? The term currency exchange, buying and selling foreign currency or Forex, is derived from two words, foreign exchange. Currency trading is the buying and selling of currency as a contract at a specific time and date by considerations of their value difference. Important notes about Forex trading. So before we continue our today's lesson, so here is some important notes about the Forex trading that you have to remember that. 1. In reality, the statistics show that most active currency traders will leave more money in the market than they walk away with. 85 to 90% of newcomers with no knowledge and experience in this business lose money. So I can say that not only 85 to 90%, 100% you will lose your money if you have no knowledge and experience in this market. Second, reading Forex books and attending courses will lay the groundwork for successful trading, but certainly doesn't guarantee it. Unfortunately, the most valuable lessons along your journey will be expensive through the experience and knowledge. Third, the FX market have been hotbed for money laundering, Ponzi scams, and other types of investor fraud. Be very careful that you are dealing with the right broker and the right people. I know you might face with the people that you're promising a big profit, or they will ask you that they can manage your funds with the very excited profits, but never trust to those people, because if they could be such successful, so now they are already a millionaires, so they do not need your money or your fund for managing that in the Forex market. Or never trust to any websites that they are advertising the robot trading systems, or do not trust to any websites that they are asking you to invest in their sites and they will trade on behalf of you for promising of big profits. So be very careful. This is also very important that you are trading with the right broker. In the coming lessons, we will teach you how to choose the right broker. And also there are some people that they might advise you for trading, but be careful. They are the right people and they have enough experience and they are already successful in this market. So I would suggest you try to learn by your own. Never trust to any people when you are trading. 4. Never trust any individual or company while promising easy profit from buying or selling currencies in Forex. There are plenty of landmines that the average retail currency trader will be forced to tiptoe around. So there are money brokers or money marketers that they are advertising their brokers and they promising easy and huge profit while simple buying and selling in the Forex market. Sometimes they will show you some videos or screenshots that they made millions in a very short times. Never trust to those individual and company. They are just advertising their brokers and they know already that the newcomers will lose the money. So that's why they advertising that if you come to that broker or if you come to the Forex investor, you can become a millionaire within a night. Never trust that. 5th, if Forex trading was such easy, so today all multi-billionaires shall be Forex traders. So it's obvious that Forex trading is not that so easy. Don't think that if you enter this business with no experience or knowledge, you can print the money. It's absolutely wrong. 6th, those who aren't proficient and alert enough to separate truth from fictions could lose all their hardly saved capital. Be enough smart that always you can separate truth from the fiction. In this market, there is too much rumors and too much wrong or right news. So always be careful. 7. I want traders to be realistic in their expectations of risk and reward by acknowledging the difficulty of the task. Some of the best FX traders in the world struggle to make 20 to 30% per year, and many would be happy with much less. Don't forget, most people lose money. Forex is not the place of printing money. 8. I'm not here to deter or discourage anybody from trading Forex, nor I'm insinuating that there isn't money to be made in currency trading. In fact, I have to share the truth about this business as an instructor. Forex trading is not easy as you might hear from friends or you see in any advertisements or on social media. 9. Always keep in mind, in forex trading, the opportunities for those seeking the possibility of slow and steady trading profits. 10. If 30% annually was enough to get uber rich, it should be enough to encourage all of us. So forget about the triple digit gains. Even if you are able to make 100% or more in a single year, it is likely you are taking on too much risk and leverage. If so, the fund probably won't last. So when you are trading in a forex, so don't force yourself that you have to make 100% profit in a month or 3 digits in a year. No, the more important is the consistency of the tradings with the lower profit. So just continue with the lower profit no matter if you cannot make money 100% in a month. And it should not be like that. The most important in this market is consistency, even with the lower profit, as we have mentioned. If you can make 30% per year, still it's a big amount. So if you can make 20 to 30%, it means that you are a top trader. So if anyone telling you the histories that somebody could make more than 100% in a month or days, be sure one day he will lose everything. And such types of taking risk never last. Forex market. The forex market is a worldwide decentralized over-the-counter financial market in which counterparties can facilitate the trading of currencies. The true forex market is composed of several electronic communication network exchanges between banks, institutions, and speculators. The forex market is one of the most liquid decentralized markets in the world, which is experiencing rapid and staggering growth with the efficiency of technology. The main participants in this market are larger international banks, financial centers around the world, function as anchors of trading between a wide range of multiple types of buyers and sellers around the clock, with the exception of weekends. Since currency are always traded in pairs, the foreign exchange market does not set a currency absolute value, but rather determines its relative value by setting the market price of one currency if paid for with another. The currency pair and currency code has explained in the previous lessons. It's very important lessons. If you are a beginner, you must watch that lesson by clicking on the link in the description below. According to the Bank of International Settlement, the preliminary global results from the 2002 survey of foreign exchange and OTC derivatives markets activity show that trading in foreign exchange markets 7.5 trillion per day in April 2002. This up from 6.6 trillion in April 2019 compared to 1.9 trillion in 2004. So as per the survey, it shows that this market has very high liquidity with 7.5 trillion trading volume per day, which is much more higher than the stocks or any other online markets. So we can see this is the biggest market in the world. Forex history. In this part, you will learn how, where, and when the Forex started for the first time and how it developed as you see today. The history of currency exchange dates back thousands of years ago and coincides with the appearance of minting coins. Since coins were made of different weights and different metals, their value could be measured according to their weight and type of metal they are made of. This difference in the value of different coins causes difference in the value of each coin in the transaction. So consideration of different types of coins value during the exchange, indeed it was currency exchange, such as what today we are calling Forex. Gold to silver exchange during Lydian dynasty, King Croesus. The official exchange of two different metals was recorded during the Lydian empires around 550 years before Christ, and also first bimetallic monetary system was established during the Croesus at that time. The silver coins were changeable to gold at the 13.1 official rates. Here you can see the gold coin which was minted by King Croesus that had 10.75 grams as per Sardis mint, and the other coin is silver that as per Sardis mint has a weight of 10.59 gram. These two coins, which was called gold Croesus and silver Croesus, they were officially exchangeable. One Sardis mint gold coins was to 13.3 Sardis mint silver coins. So this shows that it was the first time that the gold was exchanging to the silver or silver to the gold, and as per record it could be the first official exchange of two metals, an official exchange rate for two metals. Amsterdam exchange market. The first true forex market was in Amsterdam approximately 500 years ago. The exchange allowed people to freely trade currencies to stabilize currency exchange rates. Fixed exchange rate. In 1875, the gold standard was implemented, meaning countries were only allowed to print currencies equal to the value of their gold reserves. This means all currencies were backed by gold and the fixed exchange rate was applied. Gold was the metal of choice due to it being rare and having low inflation. The gold standard could not hold up during the world wars due to countries having to print more money to finance the war expenses. So we already have explained the gold standard in the first chapter. So if you are newcomers to this lesson, so I would suggest you please watch the gold standard lesson from the chapter 1 by clicking on the link in the description below. It will help you for better understanding of this lesson. Currency pegged exchange rate. After World War II, the Bretton Woods system was established. It called for most currencies to be pegged to US dollar, which was backed by gold reserves. The pegging regime only lasted until Nixon shock in 1971. So we already have studied the Bretton Woods in detail on the first chapter. So I would suggest you to watch the Bretton Woods lesson by clicking on the link in the description below. On the Bretton Woods system, the dollar was fixed to the gold and the other currency was fixed to the dollar. And the other countries' currencies only was allowed to exchange to each other currency by ±1%. So it's called pegged exchange system. In the currency pegged exchange system, in 1971, President Nixon announced a freeze on the dollar's convertibility to gold due to rising inflation, deficits of the US gold reserve compared to the US printed dollar, and possible gold run. So by freezing the convertibility of dollar to gold by Nixon shock, the pegged exchange system stopped. Emerging fiat money and free-floating exchange system. In 1973, the gold standard was completely abolished and the US dollar was no longer backed by gold reserves and foreign exchange switched to free-floating system. The free-floating system currency's value were determined by the supply and demand in the market without government interference. We already have studied the fiat money in the previous lessons, so I've mentioned the link in the comment below as well. And so as a brief, fiat money is government-backed paper money. It's not backed by gold or silver. So in 1973, after the Nixon shock, no currency in the world backed by gold or silver. They are only backed by the government and government's economic policies and which back the country's currencies. So the Forex market or the floating system that today we are experiencing in our trade, it is emerged in 1973 after the Nixon shocks or closing the convertibility of dollar fixed rate to gold. Emerging online Forex trading. When the websites for use by the general public began to emerge in 1994 and the complete removal of commercial restrictions on the internet use by the following year, 1995, it had hugely beneficial impact on investing, especially for retail investors and online traders. From 1996 to 2000 was the first generations of Forex online trading platform. The initial stage of trading platform was based on basic program downloaded to computers. The next stage was web-based platform and mobile devices such as tablets and smartphones since 2010. Thanks for watching this lesson. Don't forget, subscribe to our channel now.